Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. Puerto Rico may become the world's #1 destination for CBD manufacturers, and it all boils down to dollars and cents. Puerto Rico right now is offering incentives that can't be matched by any other country in the world, and yet Puerto Rico is right in our backyard as a U.S. territory. It's currently offering no U.S. income taxes for selling products within the U.S., duty-free importing for products from the United States, low corporate tax rates as low as 4%, exempt real estate on personal property taxes, with as little as one shareholder forming a corporation. As a protected U.S. territory, Puerto Rico offers unique benefits to its corporations, including no U.S. taxes for selling products in the U.S., duty-free imports of products from the U.S., low corporate tax rates, real estate and personal property taxes exempt during the first year, and only one shareholder can form a corporation with no minimum authorized capital, and nominee shareholders and directors can be appointed. Puerto Ricans are American citizens but don't have the right to vote in federal election and don't have congressional representation. And since there can't be taxation without representation, Puerto Rico does not pay federal taxes. Instead, Puerto Rico has its own tax code, and the IRS has special rules that apply to Puerto Rico. Within this framework, Puerto Rico is able to make its own taxation laws for companies operating from Puerto Rico. The government of Puerto Rico has taken this opportunity to create the Act 20 and 22 tax incentives, among other tax incentives and economic development initiatives. Puerto Rico has a corporate tax rate as low as 4%. The applicable tax rate on net long-term capital gains, dividends, and partnership distribution is 10%. Ordinary taxable income is taxed on a progressive tax rate from 0 to 33%. Act 20 offers an attractive tax incentive for companies at a fixed rate of 4% and minimal requirements that establish and expand the export service industry on the island. The tax incentives are guaranteed for 20 years. Some of the incentives include products imported from the U.S. exempt from duty taxes, 100% tax exemption on dividends, 60% exemption on municipal taxes, and no federal taxes on Puerto Rico sourced income. Some of the qualifying services are for research and development. So if you're looking for a different terpene flavor, or you're growing a different strain, or you're simply hiring a scientist to do some R&D, regardless, you need to have an entity in Puerto Rico doing something. You could do advertising, marketing, public relations, basically anything on the internet for social media. And that could also be bilingual. Everyone there speaks Spanish, and so you could just pay somebody at a call center or a professional PR firm, but regardless, you need to be looking into that. Other qualifying services are consulting and management, and any other service designated by the Secretary of the Department of Economic Development and Commerce of Puerto Rico. That one guy literally can just approve whatever. Act 22 is a law to encourage the relocation of individual investors to Puerto Rico, offering a total tax exemption on passive income generated or accumulated once that individual is a bona fide resident of Puerto Rico. We'll get into it in a moment, but essentially, if you're there 6 months, you qualify. But there's a tax-free for the first year on deductions up to 100% on real estate and personal property taxes. And individuals and businesses pay 0% on capital gains tax on assets acquired after moving to Puerto Rico. Act 73 is Puerto Rico's Economic Incentives for Development Act. It creates a maximum income tax of 4%, has tax credits of up to 50% for the purchase of local and recycled products, which could be hemp biomass or plastics or otherwise. They're offering a tax credit up to 50% for research and development for agricultural businesses, and special deductions for investments of infrastructure, machinery, and equipment. The Agricultural Incentives Law provides incentives for bona fide farmers and agricultural businesses, including a 90% exemption on contributions on earnings that are derived directly from the agricultural business if the farmer hasn't already benefited from the provisions, as well as 100% exemption on any of the payments going to Puerto Rico's Treasury Department and fees to register the property used in the agricultural business. 100% exemption on municipal taxes on intensive agricultural activity, 100% exemption on property taxes on land, building, equipment, and vehicles owned, leased, or are used intensively in the agricultural business. The Act for Tourism Development provides incentives for a variety of projects such as agricultural tourism and medical tourism. This includes up to 100% tax exemption on excise tax on imported goods, up to 100% tax exemption on sales and use tax. There's a tax credit up to 50% on all cash paid for equity, or 10% tax credit on the total project cost. Regardless of where you're at, it's probably beneficial to at least look at having some entity in Puerto Rico, whether it's a bilingual call center, research and development team, or otherwise. You can have storage, you can have shipping, you can avoid import tariffs by having. Side note, I'm not an attorney or an accountant, but in theory, you can circumnavigate the trade tariffs by using Puerto Rico as a go-between and avoiding some of those higher taxes. The current administration is already imposing some tariffs on China, is expected to have a direct impact on several sectors in the cannabis industry, in particular the cannabis vaporizer companies. Others are likely to be affected to include the cultivation operations that want to expand their greenhouse facilities, growers that need to buy lighting equipment, brands that purchase packaging equipment from China, and businesses that buy materials made from Chinese-made steel and aluminum, such as extraction equipment. So what do you need to do to qualify to be a bona fide resident of Puerto Rico? It's pretty easy. You need to spend 6 months on the island. You need to file a new local LLC business license or corporation. The owner must receive a reasonable salary based on the services provided, so you can't just pay somebody $1 or a penny a year. It needs to be real. And that business must file an annual report, including information such as applicable permits, certifications, licenses, and registrations. And your decree may require hiring a local employee. And so what are some of the current opportunities? They range widely. I've got one client in San Juan. He's got 250 acres, approximately 30 minutes from the airport, 45 minutes from the cruise terminals in Old San Juan. The property is by the touristy Cocoa Beach area. It sits right behind Trump's old golf course and is ready for hemp cultivation and processing, as well as medical marijuana tourism, which both have significant tax credits or exemptions. The University of Puerto Rico is also interested in the hemp project, as well as their Department of Agriculture, although that client is severely delinquent on all payments since the last hurricane. Other opportunities include a publicly traded entity called ISO Corp. They have cultivation and manufacturing licenses, 3 dispensary licensing, with additional land approved for expansion and producing and processing cannabis. ISO is a science and technology company using innovative and proprietary products and technologies to promote wellness, cures, and remedies. Their activities span across the entire continuum of therapeutic medicinal cannabis applications, from plant reproduction to precision cultivation to hydroponic extraction to drug delivery. Their goals are to maximize the worldwide sales opportunities for their proprietary and disruptive cultivation and extraction technologies. And after a few years of development and over $4 million in investment, they're beginning to aggressively commercialize and take their unique growing and extraction systems to market. Their leadership and world-class scientific teams have the skills and experience to execute their business plan and continue with the R&D mandate. And their revenue model is expected to achieve strong margins with substantial EBITDA and cash flow. Utilizing Puerto Rico, the ideal scenario is to have some sort of entity in Puerto Rico. You operate anywhere. You incorporate in Canada and eventually be on an indice where you're publicly traded, you're on an index or ETF, and then you're global. Canadian cannabis consumer packaged goods firm Slang Worldwide has formed a partnership with Southern Development Holdings to sell its cannabis products in Puerto Rico. Toronto-based Slang granted an exclusive license to SDH to produce the Slang products in Puerto Rico. Under the partnership agreement, SDH would manufacture and sell Slang's products in medical cannabis dispensaries throughout Puerto Rico. Slang will receive royalty payments in each Slang branded product sold in Puerto Rico. The partnership is expected to begin sales in the second quarter of 2019. Puerto Rico has one of the highest numbers of medical cannabis patients per capita of the U.S. territories. As of February 2019, there were more than 59,000 patients in 71 dispensaries, according to the Puerto Rico Department of Health. Puerto Rico is also the only place in the world as an American that you can go and not be forced to pay income tax. So Puerto Ricans are U.S. citizens, but they don't have congressional representation and they can't vote in federal elections. And since there can't be taxation without representation, you don't pay U.S. income tax. Now, Puerto Ricans have their own tax system, but after the last Hurricane Maria, they revised what's called Act 20 and Act 22. There's Act 73 and 74, depending on if you're going to live there or just work there, or if you're going to work on exports or other opportunities. But essentially, Puerto Rico is the only place in the world that you can go and not be forced to pay income tax. So there's a 4% corporate tax cap. You have 50% tax credits. There's 100% tax deductions. And in fact, your first year, everything is tax deductible. So Puerto Rico is probably the number one place in the world for any, let's say, CBD company for now. Puerto Rico is the number one place in the world for any CBD company to do business because of the tax advantages. So you can operate anywhere in the world, have your headquarters in Puerto Rico 6 months out of the year, 183 days is the qualification. But still, you can go up to Canada, you can register up there with an attorney and then eventually do a reverse takeover, or if you have more money, you can do a traditional IPO. And so you have all of those advantages of initially being able to have some tax advantages in the US while still looking for additional capital up in Canada and operating in between. So Puerto Rico is definitely a growing cannabis market. Puerto Rico offers reciprocal dispensary access to out-of-town visitors who hold active cannabis medical marijuana licenses from qualified state programs, as well as online registration for those interested in obtaining a medical cannabis permit. Slang is quoted as saying, "We're excited to bring our high-quality brands to consumers in Puerto Rico and the Latin American market. Building global brands requires teamwork, leveraging partnerships with the highest caliber operations, enhancing Slang's brand share and revenue with impressive scalability." This week's cannabis news: the FDA and CBD, the States Act, Cresco and Origin, House Europe, and High Times. This week brought in big cannabis news with the FDA setting its first hearing regarding CBD's legality in food and drinks for May, and the States Act, which aims to protect cannabis businesses and users in legal states from federal intervention, being introduced in Congress. As for the FDA's hearing on CBD, Tim Moxley, the founder and edibles brand Botanical Global, said that he thinks it's a huge step forward for consumers that are clearly very excited about having CBD introduced in everything from topicals to infused food and beverages. A surge of businesses are coming out with CBD products, and FDA guidelines and rules would enable the industry to seriously commit to producing the hemp-derived products that are already being sold in legal states. In other news, Cresco Labs acquired Origin House for about $825 million. The CEO told Green Market Report that many of these combined companies feel they can be stronger competitors if they're bigger players. It feels as if all the multi-state operators are prepping themselves for the day that all the state lines drop with regards to the cannabis industry. And Cresco Labs has a great reputation in the industry, so she's sure that the Origin House is happy to team up with them. Here's a brief recap of the top cannabis stocks with a market cap above $400 million. Acreage Holdings at 4.1% over the last 5 trading days. Afria up 8%. Aurora up 1%. Canopy down, or flat rather. Curaleaf at 8.3%. GW Pharma down almost 2%. And Tilray down over 9%. And High Times is undergoing a larger corporate restructuring aimed at stepping up its content and products. CB2 Insights, a provider of predictive analytics tool and data-driven software for the cannabis industry, acquired Colorado-based medical cannabis clinic group Ray of Sunshine Health Services, operating as Relax Clarity. This acquisition follows the March 20th announcements of an arrangement to acquire Arizona and Colorado-based Medieval. Quote, "At CB2 Insights, we continue to focus on bringing a new level of clinically validated, evidence-based data to the medicinal cannabis industry. Much of the data that we collect that is used to build analytical tools and insights come from our own clinical operations," end quote. Hemp company Folium Biosciences announced the launch of Folium Finance, which they said is the hemp industry's one-stop shop program offering CBD hemp customers supply chain financing, competitive CBD merchant processing services, traditional accounts, CBD hemp-friendly credit lines, P&C insurance, and employee insurance benefits. CropLogic Limited, a global agricultural technology company, said it's utilizing agricultural technology to optimize yields from its trial hemp farm in Oregon. After receiving its first shipment of industrial hemp seeds, the company is germinating them at a third-party nursery in Oregon ahead of a May scheduled planting. While the passing of the Farm Bill in late 2018, acreage under industrial hemp in Oregon has and will continue to increase significantly, said CropLogic CEO James Cooper Jones. Quote, "By demonstrating CropLogic's technologies such as CropLogic Real-Time on industrial hemp at its trial farm this season, CropLogic is well positioned to take advantage of what's likely to prove a lucrative and expanding market." Here's your weekly deal watch. Debt capital raises increase among public cannabis companies. While the total number of capital raises in the cannabis industry so far this year remains less than the same period in 2018, debt raises among public traded companies are significantly outpacing those of last year. Public companies have been involved in a total of 33 debt raises for the first 13 weeks of the year, compared with just 19 in the same period in 2018. The value of the debt raises totals $765 million in 2019, compared to just under $475 million last year. The fact that there's more public companies in the cannabis space compared to the previous year may be a contributing factor, but the data also showed that these companies are actively seeking funding, primarily to drive further expansion. Moreover, debt funding gives companies an alternative to equity financing, which requires businesses to issue more shares. Debt financing is a good indicator for the industry. It's more normalization. It's showing that investors are willing to not only invest in the industry in equity, but to take on more risky investment vehicles like debt financing, which we really haven't seen a whole lot of. But according to the data from Viridian Capital Advisors, it looks like those transactions are increasing, which is all a good sign for the industry. The U.S. is gaining ground on Canada's struggling race for pot revenue. Planet 13 Holdings generated more revenue from one flagship store in Las Vegas last month than Cronos did across Canada in the fourth quarter. Yet Cronos' market value is about 21 times larger than Planet 13. The valuation gap is just one dramatic example of the persistent disconnection between Canadian and U.S. cannabis stocks, and a reminder of the potential size of the American pot market as legalization spreads. Canadian companies with U.S. operators have been held back by the illegality of the drug at the federal level, which has depressed their shares because it's harder for them to access top exchanges, banks, and institutional investors. But the big Canadian cannabis companies are facing their own limitations and restrictions that are eroding their first mover advantage. On a whole bunch of fronts, the head start that they had is rapidly eroding. In many ways, the U.S. multi-state operators have a significant competitive advantage now over the Canadian companies. Based on their latest quarterly numbers, the two biggest Canadian companies by revenue are Canada's Canopy Growth and Aurora Cannabis. The next four operate in the U.S., and American companies now make up 6 of the top 10. In addition, most of those U.S.-focused firms generated higher gross margins than their Canadian counterparts in the most recent quarter, according to Bloomberg data. Among the top 10 companies by market value, the split is now 50-50. The numbers are indicative of the double threat faced by the Canadian cannabis producers of domestic sale limitations and exclusion from the huge potential of the U.S. market. Canada's legalization of recreational pot in October gave its companies early access to the capital markets and an eager investor base, but the rollout has been patchy with product shortages and limited retail network curbing retail sales. Meanwhile, any Canadian companies that are listed on the Toronto Exchange, the New York Stock Exchange, or the NASDAQ are restricted from operating in the U.S. because of federal laws. So this means that Canadian licensed producers risk missing out on the markets that estimated to be worth $22 billion in legal spending by 2022, leaving the spoils to their U.S. counterparts. By contrast, the Canadian sales are forecast to reach $3.8 billion by then. Several Canadian firms have established international operations in places like Europe and South America, but that isn't really a substitute for U.S. growth. Canada's restrictive marketing rules make it difficult to establish recognizable consumer brands, and their country's cold climate isn't ideal for growing cannabis. In addition, U.S. legalization of hemp has made the popular non-intoxicating CBD compound more widely available across south of the border, all adding up to a disadvantage for Canada. For now, Canadian producers benefit from significantly higher prices than their U.S. counterparts. Wholesale prices averaged Canadian $6.94 per gram in the week ending April 5th, or about $2,360 per pound, more than double the average price per pound in the U.S. The gap is bound to close as significant growing capacity comes online over the next year, eroding margins. This poses a challenge to Canadian companies that are already struggling to generate revenue growth. Meanwhile, the big U.S. players are engaging in large-scale acquisitions, including Harvest Health and Recreation's recent acquisition of Verano Holdings and Cresco Labs, both all-stock deals worth over $800 million. Canada hasn't yet lost its first mover advantage, though it's at risk, according to a recent analysis of the market by ArcView Market Research and BDS Analytics. By being the first among major world economies to move to an adult use legalization, Canada has already created the most valuable cannabis companies in the world. Whatever happens in the domestic market, the race for world domination is theirs to lose. The recent cannabis banking bill is set to boost gains for cannabis companies. The much-awaited cannabis banking bill was finally passed by the House Financial Services Committee on March 28. This opens up avenues for legal and effective financing for cannabis companies in the U.S. The bill seeks to safeguard the process of financial lending to cannabis companies in the country. It would not only protect the industry's credit lines, but also aid cannabis ancillary industries in the country. The ancillary sector has been suffering from financial uncertainties associated with the legal status of cannabis in the past. The wave of cannabis IPOs are supposed to continue in 2019. With the host of cannabis companies listing in 2018, the trend is likely to continue this year, courtesy of the favorable conditions. The Cannabis Heavy Exchange Traded Fund ETFMG Alternative Harvest Index rallied 45.8% this year to date. It's largely expected that Pax Labs, a cannabis-focused vaporizer company, will soon go public. The company raised $20 million last October. Next on the list might be Harborside, the California-based operator of a chain of retail pot shops. Current players in the cannabis industry like Cronos, Aurora, Innovative Industry Properties, and Canopy Growth have posted excellent year-to-date returns of 77, 82, 80, and 61% respectively. Canada made history by becoming the first G7 country and the second country overall to legalize adult use cannabis. So a study shows that Canadian cannabis market could reach $5.2 billion by 2024. Of course, the legal rollout of Canadian cannabis was fraught with shortages and limited retail presence of poor product selection. In 2018, legal cannabis spending grew by 65% to $670 million. However, in the last 2.5 months of 2018, adult use sales reached $112.5 million, falling short of estimates. It's my opinion that a lot of these investors are just speculators anyways, but they're probably investing in the fact that there's exports to places like Germany, where they have 70,000 individuals that have authorized insurance for medical cannabis, as well as other countries. There's dozens of opportunities for international export for Canada. So I don't think local consumption is necessarily the end all, but these firms are expanding their presence not only in Canada, but in other countries, either through exports or by establishing full-scale cultivation and distribution operations. No matter what occurs in the Canadian cannabis market, these companies have already established themselves as a global leader. Shortages weren't completely unexpected in Canada. We've seen that in every single state and every new entry, so we all expected it. Stricter rules in some provinces mean that overall cannabis spending might be affected, with more consumers continuing to access the illicit market and its lower prices. In a new report, ArcView Market Research and BDS Analytics projected the legal cannabis market in Canada could reach $5.2 billion by 2024, with the bulk of that figure representing adult use sales. The theme seems to be that companies are going to Canada and filing IPOs to access the capital, using that coming back into the States and buying hemp assets, probably to take advantage of the 280E provisions. And use as many tax write-offs as they can in the eventuality that cannabis THC is legalized, and then they can utilize all those property, plant, and equipment. So in the meantime, how many more companies are going to come into the market? And so Yahoo Finance brings up the question, when will Aurora Cannabis make its move into the U.S.? Aurora Cannabis can't expand into the U.S. market. At least it can't do so and retain its listing on the New York Stock Exchange and Toronto Stock Exchange as long as cannabis remains illegal at the federal level in the U.S. But two of Aurora's peers, Canopy Growth and Tilray, are already making moves in the U.S. cannabis market in a different way. Hemp is now legal in the U.S. thanks to the passage of the 2018 Farm Bill in December. Canopy is building a hemp industrial park in New York to produce hemp-based cannabidiol. Tilray recently acquired Manitoba Harvest, which has hemp food products in around 13,000 U.S. stores. So far, however, Aurora hasn't announced any deals about expanding into the U.S. When will the company make its move? Aurora executives stated in the past that they were eager to expand in the U.S. hemp market, but after the 2018 Farm Bill became law in the U.S., legalizing hemp in the process, Aurora took no immediate action. The main question for Aurora Cannabis with its expansion into the U.S. hemp market is not if, but when. Discussions and negotiations with prospective partners take time. Aurora chairman Michael Singer told BNN Bloomberg recently that an announcement of partnership could be on the way within the next 6 months. Singer said that Aurora is in active talks with several companies, including some of the consumer packaged goods and beverage industries. The bottom line is that Aurora Cannabis is coming to America in a major way. It's just not as big of a rush to do so as some investors might prefer. Washington State could really use some of that Canadian investment capital, as this chart from Marijuana Business Daily shows low prices and lack of investment stifling the cannabis growth capacity in Washington State. Many of Washington State's recreational cannabis cultivators are using half or less of their licensed canopy, driven in part by low wholesale prices and a lack of available capital investment, according to a report conducted by the state's regulators. Over the course of a year, the Washington State Liquor and Cannabis Board, or LCB, surveyed 1,155 licensed to determine capacity utilization and why the results were so low. The reasons were repeatedly cited. Number one, concerns about overproduction. Even though the canopy report shows most cultivators aren't growing at a full capacity, doesn't mean overproduction isn't a problem. According to Jerry Moberg, CEO of Canasol Farms in the Okanagan Valley and president of the Washington Sun Growers Industry Association. The only piece of evidence you need to know is that there's an overproduction is that you can buy an ounce for $40 down the street, he said. Businesses are going out of business left and right. The LCB has the authority to change a cultivator's license type if the business fails to use at least 50% of its allocated canopy, though regulators currently have no plans to do so. Rather than stepping down the licenses, Moberg would like to see the LCB go after cultivators who are growing beyond canopy limits. Number two is access to capital is problematic. Washington state cannabis companies are barred from accessing out-of-state capital, but Aaron Pickus, spokesperson for Washington Cannabis Business Association, said his trade group is vigorously advocating for at least a partial lift of that ban. A lack of capital creates a barrier to increasing the value and footprint of your business, Pickus noted. But the low price point for flower may limit investors' interest if flower is a grower's sole focus. The biggest return on investment that we would see in Washington is going to be on the R&D side, the talent acquisition side, areas like that, Pickus said. Number three is the prohibitive cost of expanding cultivation facilities. Fully building out a cultivation operation can prove to be a cost-prohibitive undertaking. Alex Cooley, co-founder and vice president of Seattle-based Solstice Cannabis, estimated a cost of $100 per square foot to develop indoor grow space, but it could easily hit $250 to $300 per square foot, depending on the bells and whistles in the operation. Cooley offered a ballpark figure of up to $25 per square foot to develop an outdoor cultivation operation. He said the price for greenhouse development was somewhat between indoor and outdoor setup costs. We covered this in a previous podcast for Cannabis Lab, Lawyers, Accountants, and Bankers, where Todd Arkley of Arkley Accounting Group said that he doesn't even recommend Washington to investors. There's been a massive lack of investment, but for a lot of reasons. There's just too many limitations in the state and too many producers. And so ultimately, it's just cause for a lot of restriction and lack of growth. And ultimately, a lot of companies aren't doing well because of the lack of banking and alternative investment on top of that. I think we'll end up seeing some capitulation, consolidation, mergers, bankruptcies, if they can go bankrupt for a Schedule I drug. But ultimately, there's going to be a lot of people that lose their mom and pop shops. And so there's some hidden costs to losing local businesses. For example, a corporate chain can't replace a neighborhood character and variety. There's a loss of neighborhood character and variety replaced by homogenized chains and lifeless shuttered storefronts. U.S. supply chains getting excited about cannabis. Companies can't stop talking about cannabis, hoping in part that they can catch the investor interest as the booming economy around the drug lifts revenues throughout the supply chain. In a sense, many companies are looking to replicate that strategy of lawn and garden products. Company Scott's Miracle-Gro, which has transformed itself over the last couple of years into a player in the cannabis industry by focusing on the sales of lighting, fertilizer, and growing systems specifically made for cannabis. Shares of the company, which acquired a competitor in hydroponics for $450 million in 2018, are up nearly 30% for the year to date, a rally about double that of the benchmark S&P 500. But just about how much revenue will come from cannabis-related sales into businesses that are further afield from the plant remains unclear. For supply chain companies like Chart Industries, revenues from cannabis realistically could be a couple of percentage points a year. That, however, doesn't mean it will be insignificant. In the gold rush, it was up to people who were making the picks and shovels for the gold miners that made the most money. This is the case for a lot of those companies that have absolutely nothing to do with the cannabis historically, yet it's benefiting from the picks and shovels opportunity. The outsized investor interest in cannabis and growing recognition of cannabis as a therapeutic drug may prompt more company management teams to openly discuss how their products are used by the cannabis industry in hopes of attracting shareholders. Some, like alcoholic beverage company Constellation Brands and tobacco company Altria Group, are making investments in the cannabis industry to proactively move into an industry that poses a threat to their existing business lines. Yet others are starting to discuss canopy as a way to tap into changing attitudes towards cannabis. Either way you look at it, people are jumping in. It's either a money grab or it's for holistic purposes, but regardless, I think that this is going to be the biggest transformation of wealth in history, or at least that we've seen in the last generation. Here's a report from ELO and MGO CPA. a roadmap for cannabis industries, IPOs, and RTOs, how to go public in Canada. There are as many reasons to raise capital as there are companies seeking to do it. The proceeds can be used to expand existing operations, introduce new product lines, enter new business markets or states, acquire other operators or license holders, invest in research and development, pay down debts and improve financial health, and so on. In Canada, medical cannabis has been legal since 2001, and adult use cannabis was legalized nationwide in 2018. The legality of cannabis in Canada, plus a welcoming regulatory, financial, and investment environment, has made the nation home to a number of large cannabis enterprises. This has all led to the growth that's been fueled by the ability to access capital via public listings. The two most active exchanges, the Toronto Stock Exchange and the TSX Venture Exchange, are proudly home to a number of large cannabis companies. But similar to their peers in the US, they currently impose restrictions on listing companies that have plant-touching US operations. The Canadian Securities Exchange is an alternative exchange focused on micro-cap and emerging companies. The CSE calls itself a modern and efficient alternative to companies looking to access the Canadian public capital markets. As a result, the CSE offers simplified reporting requirements that lower the barriers to listing. Perhaps most importantly, the CSE has taken a progressive approach to the cannabis industry and does not block companies with plant-touching U.S. cannabis operations. As a result, the growing number of U.S. businesses are seeking to list on the CSE. The emergence and subsequent rise in value for cannabis companies listed in Canada has been a highly discussed topic for the last several years. Cannabis companies seeking capital know that listing in Canada will earn attention. As a result, a feedback loop has developed where investors seeking growth opportunities look to cannabis companies in Canada, and cannabis companies seeking capital know that listing in cannabis will earn attention. The trend of cannabis companies going public in Canada has also created a network of essential resources for companies seeking a listing. Going public requires support from a strong team of accountants, lawyers, investment bankers, and other advisors who guide every step in the complicated process. It's necessary to find professional service providers in both the US and Canada who have experience performing this transaction with cannabis companies. There's a cost-benefit analysis to anything, and going public is no different. So the advantages of going public is future capital raises. Once public, you can use that public market to raise additional capital at a later date, normally at a higher valuation than a private company. You have improved public awareness. Going public can be a highly publicized event, raising awareness and earning headlines that introduce products and services to an entirely new audience. There's acquisition of talented staff. Going public can make the company more appealing by offering equity ownership options to act as a motivational and retention tool. You have securities used for acquisition. Publicly traded shares can be more attractive to a seller than shares with no ready market, giving an advantage in negotiations. The disadvantage is increased scrutiny. Public disclosure rules require sharing business details. Regulatory authorities, the public, and your competition will examine that information. There's regulatory oversight. You have meeting reporting and regulatory requirement demands, a significant commitment of time and resources. You have reduced management control. As a public company, corporate decisions require approval from the board of directors and or shareholders, and it's an increased cost. There's a process of going public requiring a significant investment. The demands of operating as a public company create a continuous incremental cost burden. And you have equity dilution. Going public involves selling ownership stake to the public, and depending on current and future valuations, existing owners and investors may be diluted. And you have to weigh the time. After weighing the pros and cons and considering the impact of your company, the next step is determining the right time to go public. Capital markets rise and fall in cycles, endure technical corrections, run in streaks with or against particular industries, and also react to unpredictable political and economic events. Judging timing is equal parts science and art, with the ultimate goal of entering the market as it apexes in your favor. There are two main options for going public: an IPO or an ITO, the initial public offering or a reverse takeover. An IPO is when your private company prepares and files a preliminary prospectus with the applicable provincial Canadian securities regulators and the CSE. After completing rounds of review, you file a final prospectus. Upon acceptance, your shares become available for purchase by retail investors. Whereas an RTO, or reverse takeover, is when your private company is acquired or merges with a public shell company already listed on the CSE. Via an exchange of shares or other assets, you can gain majority ownership of the ensuing entity and its listing. The filing is only reviewed by the CSE. Shares of the entity can be sold via private placement and to the investing community. If you're trying to determine whether you want an IPO or ITO, there's some factors to consider like time. If you're in a hurry and you want to trade as fast as you can, you want to do an RTO. If you're not wanting stock dilution, look for an IPO. If you're looking for less due diligence, go with an RTO. If you want stronger liabilities, look for an IPO. If you care about stigma, doesn't really matter. If you want something that's fast in terms of timing for closing financing, look for an RTO, as well as cheap costs or less expensive costs, around $850,000 approximately for an RTO, and a IPO is around $4.2 million on average. The capital potential has a benefit more towards an IPO. There are no limits to the amounts of potential capital raised, but IPOs are commonly considered higher profile and may be more appropriate for larger capital raises. It's ironic that you're trying to get capital and yet it costs so much money to go public in Canada. So getting your cannabis company ready to go public requires significant expenditure. These costs may vary considerably depending on the size and complexity of your cannabis business operations. You're going to need to have auditing and accounting. So going public requires the disclosure of financial and operational details. Two major components of this are historical financial statements and reviews of interim periods. Legal fees are incurred when you're drafting the required filing documents, preparing material contracts, affecting, restricting, and completing due diligence procedures throughout the transaction. Marketing costs. Sharing your cannabis company's value journey is an essential stage of going public, and creating awareness in public and financial markets will be an important factor contributing to the success of the effort. So you'll incur significant expenses in drafting and distributing listing offerings, documents, and mounting a successful roadshow. So if you choose to file in Quebec, you'll be required to translate essential documents into French. There are other costs. There's filing and listing fees, securities commissions, preparing evaluation reports and other technical reports, indirect costs of leadership and staff supporting internal efforts. There's an underwriter's commission. One of the most significant expenses associated with an IPO is the underwriter's commission, which can vary anywhere from 5 to 7% of the offering and is subject to negotiation between you and the underwriter. Caveat though, that's only if you do an IPO, an RTO, you don't have an underwriter necessarily because you're already buying something that is public. But other factors that are included are a natural underwriting commitment, current market conditions, type of security sold, industry and market comparisons. So again, one large advantage with an RTO option is that it may not be necessary to engage in an underwriter for completion of the transaction. Another fee is for tax advisors. So your company needs to undertake certain restructuring activities in preparation for going public, and you need to operate as a public company. So you need a team of experienced tax advisors to guide the restructuring process and ensure your company is in an optimal tax position. There's some RTO costs. Depending on the nature of the RTO transaction, there may be a cash payment involved in negotiating with the shell company. Other costs unique to the RTO will include the extensive due diligence performed on the shell company prior to completing the transaction. You're probably going to need to take a long look in the mirror and decide, is your cannabis company ready to go public? Once you've gained a significant understanding about the process involved in going public, the time and resource commitments needed, the impact this process will have on your company, then you'll be ready to make the final decision. The exact timing of the process necessary for going public is determined by a number of factors, including the complexity of the offering, the readiness of your cannabis company, and the timing of industry and market trends. The following is a recommended timeline that proves ample flexibility to assess and prepare for the issuance. With 12 months, finalize long-term business plan. You want to first finalize a long-term business plan, assess corporate governance and reporting requirements for public companies in Canada, understand the listing requirements for the CSE, establish an internal team responsible for managing the IPO or RTO, review accounting policies and historical financial records, assess the internal controls and financial reporting systems and upgrade where necessary, determine whether to seek an IPO or RTO, and then assess a board of directors and begin the process of strengthening the team. You want to perform audit reviews of financial statements and perform tax compliance reviews with choosing an external advisor for the underwriter, the legal counsel, the auditor, the tax advisor, and the IPO or RTO readiness consultant. Filing a reverse takeover isn't as glamorous, but there's a reason that High Times and other companies do it. Is primarily because it's less expensive, there's less regulatory oversight, And all in all, it's just an easier, cheaper process. It was once considered a backdoor entry to a public listing, but now the RTO has emerged as a viable and in many cases preferred option to the IPO. As a result, competition for clean shell companies has increased. A shell company can be found in a variety of shapes and sizes. Some will be formal operational companies that have gone dormant. Others have been created specifically to attract interest in an RTO transaction. Some will have cash and other assets and associated liabilities. Many promising shell companies will have an active listing on the CSE, and others can only be found via listings maintained by regulatory authorities or by working with a shell broker. So you can begin the process of identifying a promising RTO candidate by checking lists maintained by the CSE or by collaborating with investment banks, financial advisors, and other professional groups who experience navigating Canadian securities markets. With anything in the cannabis industry, there's a due diligence process. So due diligence on a prospective shell company will be performed by your cannabis company, and the shell company will do the same thing with you regarding your cannabis company. You want to be looking for a shell company with a clean history and no outstanding debts or liabilities. The company, on the other hand, will be taking a close look at your company's fundamentals to assess whether your company is ready to go public and if you and your team have the necessary experience to manage a public company. The two parties will seek to reveal liabilities, determine relative value, and ultimately decide on pairing if it's a good fit. The due diligence process will be demanding legal counsel for all related parties and will probe deeply into each respective company and its affairs by examining financial and business information, conducting discussions with senior management, inspecting operational facilities and associated assets, and reviewing contracts and other agreements. Leadership should be prepared to respond to inquiries that include business and operational performance, industry trends and competition, revenue and sales, customer relationships, accounting policies, and effectiveness of internal controls. If you're wanting to list on the CSE, your cannabis company will need to prepare an information circular containing transparent disclosures for both companies involved in the RTO, as well as management details, governance specifics, and other topics. This will be a prospectus level document that includes many of the same drafting and revenue procedures as you were drafting an IPO prospectus. The RTO informational circular will be drafted in collaboration with the shell company. Leadership and the board of directors for both companies will provide detailed information about the businesses, the material facts, liability disclosures, and other essential information gained during the due diligence procedures. Finally, the information circular will also provide information about the resulting entity and subsequent CSE listing that will result from the RTO. These details will be agreed upon during negotiation of the RTO. One advantage of the RTO process is that the same period of regulatory review and commitment are typically much shorter than that of an IPO. This is partly because the shell company already has a CSE listing and is presumably operating within the guidelines of the Canadian securities regulations. As such, the information circular does not need to be filed with or reviewed by securities regulators. Instead, the information circular will be filed with the CSE to inform them of the change in ownership control of the listing. The CSE will review the document and provide comments. If everything is in order, the CSE will issue conditional approval. Upon gaining conditional approval, you can begin executing plans for the shareholder meeting, which will be held to gain majority support of the RTO transaction. Before completing the RTO, you'll need to gain approval from the shell company shareholders. Depending on the nature of the transaction, the shell company communicating with and obtaining approval from legacy shareholders may be a complex and ongoing matter. Before the shareholder meeting, the leadership of your company and the shell company will need to complete the information circular, which provides necessary information and disclosure about both companies and also provide details about the ensuing entity. The information circular must be printed and sent to the shareholders before the meeting. Upon gaining majority approval of the shell company's stakeholders, you'll file the approval documents with the CSE. The CSE will issue the final bulletin demonstrating acceptance of the listing. Private placement funds will be released from escrow and common shares of the resulting issuer will begin trading on the CSE. Almost immediately upon closing the IPO RTO, your cannabis company will need to be prepared to meet the regulatory reporting demands of a public company. As such, it's highly recommended that you understand the requirements of operating as a public company and implement all structural, operational, financial, and governance changes prior to closing the transaction. A repeated theme on this podcast has been normalization. And so with Walgreen's new CBD push, trying to be edgy without being risky, is just one more example of us moving towards normalcy. As this Yahoo Finance article goes on to say that Walgreens will soon introduce cannabis-based products to some 1,500 stores in states where it's legal to do so in an effort to meet what it says are the needs of consumers looking for a wide range of accessible health and well-being products. Although legal weed is gaining greater acceptance in many quarters, big corporations are still very leery about becoming too closely associated with it until it's legalized at the federal level. But topical creams, patches, and sprays that have been infused with cannabidiol or CBD seems a safer way to enter the market. We have a drugstore near my house called Bartell Drugs. It's kind of a local version of Walgreens. So I walk into the store, I see that they have some Charlotte's Web and CBD products and thought that was interesting. And right across the street is an adult retirement community. So kind of dawned on me, I might want to walk in there and see if they have some questions about the products. So I made an appointment. I talked to the director of activities, or actually the director of the entire facility. So I started talking to her about CBD, and she said, "Oh yeah, I'm very interested about learning about the CBD. I don't know about it either." So she thought that that was a value add for not only her, but her residents at this retirement community. So I scheduled to have a licensed massage practitioner come in, who's a member of Normal and the Cannabis Alliance. And after we got the appointment scheduled, the licensed massage therapist said that she was really excited about teaching about cannabis. And that's when the record player just skipped and everything stopped. The director of the adult retirement community said, "Absolutely not. It's irresponsible to talk about cannabis. I would never introduce cannabis to my community of retirees and my members and the residents." And that was it. Silence after that. So I found it very interesting that you can talk about CBD, but the moment you mention cannabis, then everything stops, even though you're talking about the same thing. So the whole education component is going to be very difficult. When you have to educate and then sell, it's always the hardest thing. So even though Walgreens is going to be selling these items on an end cap with a nice display, the prices are high and the education is not there. They do have pamphlets, but people are just, they're just not comfortable with it. And then when you have places like a retirement community next door and no one there feels comfortable talking about it, it makes that even more difficult. So how do you talk about cannabis at the workplace? I don't know. There's really nothing to share on the article, so why don't you tell me? In addition to Walgreens selling CBD products and CVS, it looks like Unilever doesn't want to feel left out. So they're going to enter the cannabis market with subsidiary CBD-infused products. The move signals a growing acceptance among cannabis consumer packaged goods companies to join the fast-moving cannabis market. Schmidt's Natural, which was acquired by Unilever in December 2017 for an undisclosed sum, plans to release deodorant products that will infuse either hemp or cannabidiol as a key ingredient later this year. Now, with Unilever entering the cannabis space, the floodgates could be set to open for other major consumer good companies to offer similar cannabis-related products. As CBD tries to expand, New York is reining it in. There's confusion in the emerging CBD edibles businesses. New York City health inspectors have seized thousands of dollars worth of CBD-infused food and drinks. The crackdown came just weeks after federal law explicitly made CBD legal across the country. The New York City crackdown highlights the inconsistencies that emerged in the federal, state, and local rules governing CBD, bewildering the small but growing number of businesses selling edibles in New York and other states. Consumer interest in CBD tinctures, topicals, creams, and edibles has grown in recent years in steps with the piecemeal legalization of cannabis, which is now permitted as either a medical or recreational drug in 33 states, while still banned by the federal government. In 2018, U.S. consumers spent an estimated $300 million on CBD food and drinks, according to a report by Cohen Washington Research Group. The 2018 Farm Bill enacted in December was intended in part to clear up the legal status of CBD by legalizing cannabis extracts derived from strains of the plant known as hemp that contain very low concentrations of THC, the main psychoactive component in marijuana. But the law also created new confusion for businesses wanting to sell CBD food or drinks. For some, it's impossible to follow one set of regulations without being in breach of another. It's unclear whether New York City's health department will allow cafes and restaurants to sell CBD edibles, even as a dietary supplement, despite New York State's officials saying such products are legal. Colorado, Maine, and other states have attempted to clarify the states of CBD-laced edibles by passing laws allowing the addition of CBD to food. The FDA said it may make an exemption for CBD, allowing it as a food additive or dietary supplement, even though it's now listed as a drug. It will hold a public forum on the issue in Maryland on May 31st. While the conflicting rule is at the best haphazard enforcement, CBD vendors say that they're pressing ahead, devising their own strategies that they feel are at least a gestures toward compliance. First comes banking, then comes taxes. The IRS tax code is crippling and devastating for the cannabis industry. Cannabis companies are facing another tax year bogged down by IRS limitations that designate them as drug traffickers and single them out for special treatment. It's crippling to businesses, said Michael Raisin, CFO of Colorado-based LiveWell. It really doesn't allow for the sustainability of these businesses. It's really that onerous. It's just devastating, he said. Rule 280E applies to the plant-touching business, those that grow, process, handle, and sell cannabis-containing products, as opposed to companies that manufacture and sell peripheral products like processing equipment, vape pens, and other paraphernalia. Specifically, the rule states that no deductions are allowed for any product paid or incurred in carrying on any trade or business if the trade or business consists of trafficking in controlled substances. The only solution to the 280E conundrum is to change the law. Cannabis companies and their lobbyists are trying to do just that. A renewed push for Congress to adopt the States Act, which is strengthening the 10th Amendment through Entrusting States Act, was reintroduced Thursday and has bipartisan support from both Republicans and Democrats. Essentially, it says if you're in a state where cannabis is a legal substance and it's a regulated industry, and you're a company that's in good standing with the regulators, then for you and your states, it's not a violation of the Controlled Substances Act. Under the tax code, cannabis businesses are permitted to deduct costs associated with producing their products, though that's where the typical business advantages end. That leaves retailers and integrated businesses at a disadvantage compared with growers. Everything you can think of that's outside the production and manufacturing costs would not be deductible under the IRS's interpretation of 280E. In response to Yahoo Finance's question asking whether Section 280E will prevent pass-through filers from deducting cannabis business-related expenses, the IRS declined to comment. Asked about its position on whether corporate and individual tax filers may deduct investment losses for stock purchases in cannabis industry companies, a spokesperson for the IRS told Yahoo Finance that the department was checking into the issue and would respond back if it found any information. Ultimately, Congress's adoption of the States Act would mean more opportunities for cannabis companies to participate in the American economy and more opportunities for those businesses to create jobs. Before you go out and buy your next cannabis business, here are 5 key factors to consider before making a cannabis acquisition. As investors aggressively pursue opportunities in the industry, the pace of consolidation continues to accelerate. CohnReznick and New Frontier Data have both seen an increase in buy-side due diligence inquiries, which correlate to an increase in publicly reported acquisitions. Among the investors pursuing deals are heavyweight players from each big pharma, big tobacco, and big liquor, as well as institutional investment companies like BlackRock. As legal issues get resolved and public support increases, the industry will become increasingly attractive to institutional investors. A looming national recession will push more investors towards cannabis, chasing yields in the strongest growth market of the last few years. Further crowding the field of potential buyers are existing cannabis businesses, including large cannabis companies traded on the Canadian exchanges, which see acquisitions as the fast way to build brands, expand market footprint, and raise their public market values. Also in the game are regional players, which are building up smaller companies within their spheres of influence to increase their respective sizes and ultimately position themselves for their own lucrative exits down the road. As M&A in the cannabis field heats up, there are 5 factors in which all sellers should keep in mind when looking to be acquired. It's not all about profitability. Many investors are focused on revenues over profitability. Why? Because the successful companies of tomorrow are those that are grabbing market share and growing revenues today. That said, for more mature companies, profitability is a vital factor. Technology is a competitive edge. The cannabis market is moving toward personalization, which requires more advanced technologies such as state-of-the-art LED lighting and cultivation centers. Advanced business systems are also important. Any acquisition target should have the fundamentals done right, such as proper software for sales, accounting, and logistics. Valuations vary widely from state to state. At this point, no 2 states are alike. A cannabis company in Oregon may have an entirely different valuation from a similar company in Florida. Oregon has very low barriers to entry, offering a relative ease to obtain a cannabis business license, whereas Florida, conversely, grants a very limited number of operating licenses, meaning that cannabis businesses there are significantly more valuable. So, for example, a license in Washington State could sell as easy for $1 that I've seen, with royalties maybe 5 or 6%. Versus in Arizona, I've seen a partial license go for $5 million and the whole thing for sale for $20 to $25 million. Professional management teams are also essential. So a cannabis company should have a professional management team in place, and many do. As an increasing number of executives from pharmaceutical and consumer packaged good companies move into the cannabis industry, they bring along honed, sophisticated business practices. Operational efficiencies can lead to success. Like any successful enterprise in other industries, a cannabis business should have a set of standard operating procedures. For example, that company should be doing business with the right partners and suppliers to maintain continuity of supply and capacity to meet demand. It also means that the company has designed and implemented a series of processes to achieve its objectives and mitigate risks. As many factors coalesce, the cannabis industry has sparked a global rush mentality among many investors who want to stake a claim. For those considering an acquisition in the field, it's essential to first perform detailed due diligence and apply metrics specific to the industry. Properly understanding the acquisition target before the deal closes can ultimately serve to ensure a profitable outcome. And with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge, your cannabis business podcast. Like, subscribe, and share, or don't, and I'm out. Apparently, we've all smoked shittier weed than we thought. A new disturbing report came out that said most cannabis sold on the street contains fecal matter. The vast majority of cannabis sold on the streets of Madrid contain dangerous levels of fecal matter and is unfit for human consumption, according to a new study. E. coli was present in 75% of the samples analyzed, and 10% were contaminated with asparagus, a dangerous fungus which can cause lung infection, particularly in people with underlying health conditions. The average amount of fecal bacteria in each gram of resin was 500 times higher than the maximum limit set by US legislation for cannabis or by the European regulation for fruit and tea. Most of the hash sold in Madrid is not suitable for human consumption, mainly due to the microbial criteria, and represents a danger to health. This is due to the way that the hash is transported, which probably comes out of Morocco, goes to Spain via people ingesting it. And then after it's ingested, people take laxatives, and then you get the point. People are also putting these in joints, so they put filters on it, but not only do you suck the smoke, you're also sucking in poop particles. So there's no real way to get rid of that shitty weed in Spain, apparently, so be careful. I'm not suggesting that you buy shitty weed, but if you do, there is a solution. You can use hypochlorous acid. I would highly recommend you look at Briotech. You can find this on Amazon, Briotech. I used it for cannabis. We white labeled it under Salubrio, but it required FDA approval, even though it's only hypochlorous. Hypochlorous is a saline with a charge, so it's called God's tears in some countries because just like your tears, if you have an electric charge to it, it will kill E. coli, salmonella, powdery mildew, mold. It'll pop the legs off spider mites. So we went to Olympia, in the state of Washington, the capital here, and we brought it to the Department of Agriculture, and we brought it to the Liquor and Cannabis Board, and they were drooling because Washington State Department of Agriculture had spent $2 billion on the bird flu. They were very intrigued by this product because we could literally have, college kids in backpacks with flip-flops spraying this and killing everything. We brought it to a couple of labs. They were really surprised by the results, completely killed everything. And we brought it to a farm. We did some testing. They sprayed it down where there were some cracks in the foundation. Mold grew around the cracks, showing that it prevented where they actually sprayed it. And so not only as a preventative, but if something does happen, powdery mildew in the Northwest, I would imagine Florida is really bad as well. You might want to look at sprayers, and you'll start seeing this in grocery stores as well. They'll all start having it as soon as it's available. But essentially, this company here near Seattle is the only one that's been able to have a shelf life beyond 4 hours. What you'll see in commercial facilities like hotels, they'll bring in every so often a big generator, and they will charge saline. And so they'll have their own hypochlorous acid or HOCl, but it only has a temporary charge, 4 to maybe 12 hours maximum. So then they'll clean everything, they'll kill everything, done, bed bugs, you name it. But this product from Briotech has a shelf life of 4 years, and it's the only one in the world, which is why the UAE, India, countries like Chile, these countries are buying this in the event of a natural disaster. So if countries are purchasing this preventatively for natural disasters, maybe you should consider it for your facility, regardless if it's production or extraction or whatever it is, you've got an option for your shitty weed. And with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge, your cannabis business podcast. Like, subscribe, and share, or don't. And I'm out. The Mars agency released a report on how cannabis legalization is changing shopping behavior. As the industry is projected to be a $194 billion global industry by 2025, cannabis will be as disruptive to the CPG industry as Uber was to private transportation. 2018 was a historic year for cannabis. We saw first from a government perspective with Canada becoming the second country and first G7 nation to legalize adult use, and the U.S. Food and Drug Administration approving the first cannabis-derived drug. Plus, we saw significant investments from a business perspective, especially from the alcoholic beverage industry. Constellation Brands, owner of Corona and Modelo Beers, invested $4 billion into Cannabis Growth, a leading Canadian cannabis producer. Miller Coors partnered with the Hydropothecary to develop non-alcoholic cannabis-infused beverages in Canada. In the U.S., Laguntas Brewing Company became the first general market consumer product goods company to launch a cannabis product with their introduction of High Five hops. These governments and companies are following consumer demand. 1 in 5 Americans now has access to legal cannabis. According to an October 2019 Gallup poll, 66% of U.S. adults now support legal cannabis, the highest percentage ever recorded. There's no doubt that cannabis is becoming a bigger part of the consumer consideration set. Brands and retailers will need to meet consumers where they are going. The report goes on to suggest that cannabis will change retail in the following ways. 1, disrupting the consumer product goods categories. Startups and even mainstream brands are introducing and winning with cannabis products in the health and wellness, beauty, and alcoholic beverage categories. Number 2 is stealing trips from mainstream retail channels. As legal cannabis expands, it drives a shift of spending to cannabis retailers and products and away from traditional retailers and categories. And number 3, changing shoppers' expectations of retail experiences. Today's cannabis shopping experience delivers personalization, innovation, and consumer services at a whole new level that will impact shopper expectations across categories. Once a cannabis shopper finds products that are effective, they begin to navigate an entirely new retail channel in which layout, communication, and product assortment are driven by state regulation. Their path to purchase is unique and has implications not only for cannabis, but other retail channels and categories. So number 1 is a pre-shop. Most cannabis shoppers begin with a trip of pre-planned lists of items that they want to buy. 83% indicate they have a mental list of products, not necessarily brands in mind when they decide to make a trip. But even if they've decided what they want, they haven't necessarily decided where they will shop and buy. Retailer choices in this channel is similar to choosing a traditional retailer driven by location, selection, pricing, and promotion. Shoppers indicate these are the most important criteria when choosing a dispensary or to shop. Number 1 is wide selection of infused products at 36%, followed by a high quality of flower and concentrates at 21%. Competitive pricing, ironically, is the lowest at 9%. Shoppers also check information sources for dispensary specials. The leading sources of assortment, promotions, and pricing information are Weed Maps, number 1 at 30%, followed by Leafly at 25%. The retail experience is driven by state regulations, which include identification collection, staff, customer ratios, limitations on staff and customer communications. And these restrictions shape the customer experience within new retail channels. Most dispensaries have a waiting time. On average, shoppers wait in this area for about 6 minutes. And during the wait time, shoppers interact with the following information. At 30% of the time, they're looking at a digital display of product menus and pricing. And 20% of the time, they're looking at cannabis lifestyle magazines. At the third stage is shop. Across markets, there's primarily 2 types of retail layouts in the cannabis stores, the pharmacy counter layout and the jewelry case configuration. Across both layouts, state regulations on retail and customer ratios govern customer count in the sales room. So the first layout is pharmacy, where shoppers engage with the sales rep at a counter with an assortment of available products at the sales station with the availability to browse the store. And 30% shopped at a store with this type of setup. Second type of layout is a jewelry case, where shoppers can browse the store floor with products displayed in cases and engage with the salesperson, with 65% shopping at a store with this type of layout. The fourth stage is checkout. The quasi-legality of cannabis shifts traditional methods of payment with this new retail channel. Cash is still the most common payment method in this channel, but 7% of shoppers shop at dispensaries that offer cryptocurrency payments. The fifth stage is the post-shop. Similar to other channels, shoppers belong to many dispensary loyalty programs and shop at multiple retailers. 70% of cannabis shoppers belong to a loyalty program where they can learn about member-only sales and new products. The legal cannabis industry is unique in that it started when technology was already disrupting traditional industries, including retail. So it's not surprising that startups are popping up all over the place to be the next big thing of cannabis. In addition to innovative cannabis retail platforms for shoppers, there's also several companies emerging to serve dispensaries that sell online. While other categories and retailers are struggling to keep up with the latest technology platforms and delivery services, the legal challenges facing the cannabis industry has driven unprecedented innovation and resulted in new winners and losers. As legal cannabis expands to more markets and continues to grow online, we expect to see more startups to emerge with further enhance to the shopping experience. Whether your company is already in the cannabis space or watching it grow from a safe distance, here's what you need to be doing today to leverage the mainstream cannabis movement. Number one is understand consumer needs and impacts to shopping behavior. We know that cannabis shoppers care about staying well, and this wellness trend impacts demand across multiple categories and retailers. When consumers use cannabis for wellness and symptom management, they stop using destination categories, including prescription drugs, vitamin supplements, and OTC medications, meaning fewer trips to traditional retailers. Size the impact and opportunity of cannabis to your space and follow the consumer needs in your category. Number two is deliver unmatched shopping experience. Cannabis shops of all sizes across markets are stealing trips from traditional retailers and delivering premium, convenience, and innovative shopping experiences. Number three is experiment with retail innovation. The only industry changing faster than cannabis is retail. It's encouraged that all brands and retailers test and learn with new technologies and partner with the new startups to gain learning and first mover advantages. The first cannabis report from Headset Nielsen looks at weed versus alcohol sales on a big holiday. And we all know that Headset and data goes together like weed and a chillum, but you already knew that. The paper produced by Nielsen and its new data partner for the cannabis industry, Headset, is titled 420, the greenest day of the year, insights and predictions based on 4 years of data. It looks at trends and predictions for 420, the International Day of Pot, kind of like the 4th of July or St. Patrick's Day for weed. Unlike previous reports out from Headset, this one includes data from consumer interest company Nielsen. The firm, best known for putting out TV ratings and music sale information, provided numbers that uncovered a comparative view into cannabis and alcohol sales during consumption holidays. According to Headset data, April 20th is the single biggest day for cannabis sales each year, driving at least double the revenue of an average day. Interestingly enough, this year 420 will fall on a Saturday. Since Fridays are typically the biggest day of the week, retailers should be ready for 420 Eve as well as the holiday itself, Headset CEO Cy Scott explained. Adding to these comments, Rick Maturo, Associate Director at Nielsen, explained, from a Nielsen's perspective, there are certain holidays throughout the year that we see a significant lift in beverage alcohol sales. A few holidays that come to mind include New Year's Eve, St. Patrick's Day, 4th of July, and Valentine's Day. He noted, however, that April 20th is not on the list of increased alcohol sales dates. When compared to cannabis sales on April 20th, we are not currently seeing any significant lifts in alcohol sales that mirror the level of elevated sales seen within the legal cannabis space. That said, the lift in legal cannabis sales during 420 does reflect how committed the legal cannabis consumer base is, especially as they seek out opportunities for experience enhancement and socialization.
We were talking about the comparison between beer and cannabis just as a celebratory component for the holiday. And so there's this comparison with cannabis and beer holidays, taking into consideration that Nielsen partnership, and basically seeing that beer on the July 4th has a 33% increase in sales compared to only 5% for cannabis during that same 4th of July weekend, whereas with 420 there's a 111% increase.
Yeah.
So it's obviously our own little holiday.
It is, yeah. I thought it was interesting to consider because there's still a lot of question about whether how alcoholic beverages how their sales are impacted by cannabis. So I thought it was interesting that while we see a slight bump around July 4th for cannabis, it's not even as high as beer. That's kind of more of beer's holiday. But the holiday isn't about beer for most people. Probably some people it's just about beer, but most people, it's family gatherings, it's celebrating, the Independence Day. And so while you use beer to celebrate, it's not just a beer holiday. 420 is a little different from that, right? That's just a holiday about cannabis. And so I think it compares nicely, like holiday consumption from a holiday specifically for a thing.
Can cannabis revive the restaurant industry? The trend of infusing food and beverages with cannabis has been gaining steam steadily since Colorado and Washington first legalized cannabis in 2012. While brewers were early adopters in mixing legal cannabis with its derivatives into beer and THC edibles have long been popular, restaurants may be the next logical frontier for the cannabis industry. Is cannabis the potential answer for reviving the decline in overall restaurant revenues? The restaurant industry had its best same-store sales gains since 2015 last year, but that was only because many operators cut back on their promotional discounting, which pushed average guest checks up by 2.6%. Customer traffic continued to fall. Guest counts were 1.9% lower than in 2017. It's been years since the industry has seen customer count grow. Yet some are hopeful that adding cannabis-infused dishes to menus could help turn things around, and research indicates people who use cannabis tend to be bigger spenders when they go out to eat. A report from Technomic found that 63% of cannabis users said they eat more food when they have used cannabis before dining out, while only 5% said they ate less, and 28% said they drank more alcohol too. The demographic profile of the average frequent cannabis user is also attracted to restaurants. They tend to be younger, around 21 to 34, with annual incomes placing them in the middle to upper class income brackets of 35 to 100,000. Importantly, 62% of all users and 71% of 21 to 34-year-olds said that they would visit a restaurant that incorporates cannabis into its food. Restaurateurs, however, are taking a wait-and-see approach so far, due at least in part to the regulatory uncertainty at the federal level. Currently, the Food and Drug Administration regulations prohibit the inclusion of cannabidiol in food, though the substance itself is legal. The agency reiterated last December that Congress had given it the authority to regulate cannabis and noted that it had sent warning letters to some companies who have touted the alleged health benefits of their CBD products in violation of FDA regulations. It also said it had sent some warning letters because the companies were using CBD as an ingredient in food. But in 2018, when the FDA approved the CBD use in GW Pharmaceuticals' epilepsy drug Epidiolex, it immediately became illegal to add the substance into food, since pharmaceuticals are not permitted to be put into food. However, the agency has also acknowledged that there's a broad consumer interest in making CBD and other compounds more widely available, and said it was considering whether it should look into changing the rules. A public hearing on the subject has been scheduled for May. But the FDA commissioner abruptly resigned last month, and his successor may have different priorities. Still, enforcement of the law is uneven and largely left to the states, which is why you can legally purchase CBD in edibles, oils, and elsewhere. It may take only one daring restaurant chain to dive in and lead the way, but the move won't be entirely unprecedented. A parallel could be drawn for just a couple years ago when big brewing companies were initially hesitant to invest in legal cannabis companies. But the financial floodgates opened in 2018 when Constellation Brands partnered up with Canopy Growth in a multi-billion-dollar deal. Restaurants, too, might rapidly follow suit and begin taking bets on the future of cannabis as a mainstream enterprise. It may already have happened on a small scale. West Coast Venture Group, which owns the fast casual illegal burger and El Señor Sol Mexican restaurant chains in the Denver area, announced it would be opening an experimental restaurant in partnership with Americana Cafe to test out a so-called Cannabis cannabis infusion technology from Biolog. Cannabis creates solid sticks of seasoning, spice, and cannabinoids, compounds from the cannabis plant. The flavor sticks melt when cooked, infusing the foods with a subtle flavor and the effects of CBD. So long as cannabis or even CBD remains illegal or use restricted at the federal level, it's unlikely that national restaurant chains will put it on the menu. A spokesman for the Whole Foods market said that grocery store chains will not sell products containing CBD until all issues regarding the regulatory status are completely resolved to our satisfaction. So that sentiment is probably being echoed in restaurant company boardrooms everywhere. So don't look for cannabis to turn the industry green anytime soon. CBD's been stirring up a lot of buzz, so we're going to jump into the 2018 Farm Bill and find out what's next for hemp. There's new rules and business opportunities from nationwide legalization. The recent signing of the Farm Bill removes the plant cannabis sativa from the Controlled Substance Act. It's also forcing the USDA, or U.S. Department of Agriculture, to come up with some national hemp regulations, allows states, territories, and Indian tribes to submit hemp growing regulation plans to the USDA with no deadlines for doing so. The plans must include THC testing procedures, including inspections done at least annually, bookkeeping procedures to keep track of land approvals for hemp cultivation, and plans for effective disposal of hemp plants with too much THC. And it's supposed to guarantee that hemp and hemp products can be moved from state to state and imported and exported in the same way as any other crop. But just ask Idaho how well that works. What the Farm Bill does not do is give states any guidelines about regulating hemp manufacturing or processing. It guarantees interstate commerce for products containing CBD, not just the molecule itself. It limits U.S. Food and Drug Administration authority to ban CBD from foods, drugs, and cosmetics, which the agency has done, and explains whether the clause guaranteeing interstate commerce for hemp products affects the FDA's ability to limit CBD use in foods, drugs, and cosmetics. The hemp-derived CBD market has soared in recent years, but a lack of data regarding existing hemp-derived CBD sales combined with many unanswered questions about how hemp-derived CBD will be regulated and sold makes it difficult to accurately predict sales. But after extensive conversations with lawyers, regulators, analysts, executives, and entrepreneurs in the hemp and CBD industry, we've made a few key assumptions to guide our estimates. Products containing CBD will likely appear on the shelves of mainstream retailers such as Target and Walmart, but the selection will be limited. CBD is an active ingredient in the FDA-approved drug, and the agency has made it clear that selling food or dietary supplements containing an active medical ingredient remains illegal. It's less clear, however, how the FDA will treat non-ingestible products containing CBD, such as lotion or conditioner. The rollout of products containing CBD in national retailers will be slow. Although hemp-derived CBD is no longer a Schedule I controlled substance, CBD derived from marijuana plants containing more than 0.3% THC remains federally illegal. Any national retailer selling a product that contains CBD will want absolute certainty that CBD was derived legally, which means they'll likely buy only from sophisticated domestic manufacturers with strict quality control standards. It's not clear how many CBD manufacturers currently meet such criteria, and these relationships take time to develop, but it's likely well short of the number it would take to support a national product rollout. Existing CBD retailers and manufacturers will likely benefit in the short term. Current CBD consumers purchase highly concentrated tinctures, edibles, and vaporizers, a far cry from the type of product containing CBD that are likely to show up in traditional retail outlets. This benefits existing CBD retailers that are willing to take the risk and sell products that the FDA still considers illegal, allowing traditional retail outlets to function as something of a marketing platform for CBD in general. Crucial components of the 2018 Farm Bill have yet to be finalized, and several key questions, such as how long it will take the U.S. Department of Agriculture to issue regulations on industrial hemp cultivation, and how aggressively the FDA will enforce restrictions on CBD in food and dietary supplements, remains unanswered. Here's some hemp do's and don'ts. The door's been flung wide open to new business opportunities, but you don't want to throw caution to the wind and harvest your life savings in a new endeavor. So here's some things you should keep in mind. Buy federally backed crop insurance. Terms are much more reasonable for FDA-backed crop than for a crop with only state-level protection. Read FDA guidance closely. If you're making a food product, follow all federal and local food production guidelines. If you're making a dietary supplement, follow the FDA's production and marketing rules for dietary supplements. Advertising, your social media marketing and traditional display advertising has been stymied for years because of those channels hesitant to make money from an industry deemed illegal under federal law. The end of hemp prohibition means that newspapers, TV stations, and social networks have no legal barriers to accepting hemp dollars. Look for proven genetics. Kentucky and Colorado have researched the best hemp cultivars for CBD-rich flower production, with those varieties legal for sale in any state. Apply for other aid. The 2018 Farm Bill streamlines existing USDA programs to support beginning and socially disadvantaged farmers and triples the spending on those programs to $435 million over the next 10 years. The new Farmer Opportunity Training and Outreach Program gives new farmers help completing loan applications. Keep meticulous records. Hemp is now legal, but marijuana is not. Business owners at every layer of the hemp and CBD supply chain will need a paper trail to prove that products are derived from legal hemp. Don't think you'll get rich quick. Don't make health claims. Don't tune out. Don't ignore market forces, and don't play with the word organic, and don't link to any studies. Some investor insights. Before the Farm Bill was signed into law, the CBD sales were on pace to exceed $1 billion by 2020, according to estimates by Hemp Industry Daily. With this policy shift, rapid growth is expected as traditional financing and advertising ramp up. Thousands of chain retailers consider stocking products, including CBD-infused beverages, cosmetics, and pet foods on their shelves across the U.S. The bill's removal of heavy tax burdens and interstate supply limitations will boost investor confidence for an industry that's already gained keen interest among retail and consumer packaged good giants. Consider the landscape. In September, the world's largest beverage maker, the Coca-Cola Company, confirmed it's eyeing the CBD market. The world's largest retailer, Walmart, confirmed in October it's pursuing preliminary fact-finding as it considers CBD products in Canada. The Farm Bill also paves the way for Canada's largest public company operators to enter the U.S. market, a maneuver that firms can't try in the cannabis sector because of the plant's federal illegal status in the U.S. But in October, Canopy Growth spent $19 million to acquire Colorado-based Ebu, a research firm working on THC-free hemp. Meanwhile, investors can expect to see a flurry of activity among U.S.-based hemp and cannabis operators that will be compelling to gain market share and scale nationally. Stock prices of companies operating in the hemp and CBD industry oscillate throughout December, and investors seemingly undecided on how the Farm Bill will affect the business landscape. On December 12th, the day that the 2018 bill passed the House of Representatives, stock prices for Charlotte's Web Holding, Isodile International, CV Sciences, and GW Pharmaceutical all reached December highs. Those gains, however, proved to be short-lived as stock prices for all four companies steadily climbed the following week. So on December 20th, the day President Trump signed the 2018 Farm Bill into law, stock prices got a boost, which was erased the very next day after the FDA issued a reminder that it remains illegal to introduce food containing added CBD into interstate commerce or to market CBD products as or in dietary supplements, regardless of whether the substances are hemp-derived. The removal of hemp and CBD from the list of controlled substances is a major win for the industry at large, as companies should now expect easier access to capital, banking services, equipment, and qualified staff. But for individual businesses, especially those that have found success in the previous regulatory environment, the 2018 Farm Bill introduces a great deal of uncertainty. Sales of hemp-derived CBD products have largely been regulated as small or independent retail channels, such as e-commerce sites, cannabis and smoke accessory shops, as well as natural wellness stores. They've also picked up traction in alternative health settings, acupuncture, massage, and pain management clinics, for example. Hemp-derived CBD products fare less well in medical or adult-use cannabis dispensaries because of the competition there with cannabis-derived CBD and THC products. One area of explosive growth is natural food stores have had a 162% increase in sales of CBD products in the past 12 months. To date, mainstream retailers have mostly stayed out of the mix with some notable, albeit short-lived expectations. Now that hemp has been removed from the Controlled Substances Act, a mainstream retailer and consumer packaged goods manufacturer will want clarity on what they can do and can't do. But the absence of clarity won't necessarily stop some retailers from forging ahead and capitalizing on the market momentum for hemp-derived CBD products. Retailers have less product liability than manufacturers and are consequently more likely to take risks. Once mainstream retailers have some indication that dissonant states and federal regulators or federal intervention won't disrupt sales or jeopardize business, expect rapid growth in the number of stores selling these products. Mainstream retailers and beauty and department stores, Target, Costco, Walgreens, Sephora, Bloomingdale's, just to name a few, are more than likely to carry products that have established a brand name and have a record of manufacturing pesticide-free products that undergo rigorous third-party testing. A second wave of growth will happen when large consumer packaged good companies enter the mix. Think beverage, beauty products, supplements, and over-the-counter drug makers. Because of the increased product liability, manufacturers are more likely to hold out until the U.S. Food and Drug Administration provides some guidance on the hemp-derived CBD products. Mainstream retailers will control most of the market for hemp-derived CBD products, but the widespread availability of those products won't radically alter current consumer behavior. That's to say that if consumers shop in an independent natural food store and buy hemp-derived CBD products there, the sale of those products in Target or Costco isn't likely to change that consumer's buying habits. Yes, there will be some competition for specialized retail, but that already exists in the form of e-commerce. As availability and awareness of hemp-derived CBD products grow, expect moderate to strong growth in small specialized retail channels. Roughly 30 countries in Asia, Europe, and North America, South America already grow hemp cultivation. The United Nations Food and Agricultural Organization tracks global farming and reports that global acreage in hemp cultivation in 2016, the most recent year available, was 192,000 acres. The UN estimated total hemp production in 2016 at 355 million pounds. But those numbers are incomplete. Not all nations report hemp acreage to the United Nations. Among the producers left out of the UN's hemp count was Canada, where industry groups say about 138,000 acres of hemp were planted in 2018. Uruguay, which had almost 2,500 acres of hemp licensed in 2018. And Colombia, where acreage counts are not available. With those exceptions, global acreage counts in hemp cultivation in 2016 was 192,000 acres with a total production of 355 million pounds. Leading hemp producers are the European Union, China, South Korea, and Russia, with most production taking place in France, Netherlands, Lithuania, and Romania. Many of the Latin American countries that have been developing cannabis legislation have been cautious to allow cultivation and started with restrictive, import-only programs of CBD products, which opens the door for new hemp producers to enter the market. These include Brazil, Argentina, Paraguay, and Mexico. But legalization is evolving rapidly, and only Brazil has no plans in place to eventually allow cultivation. The Farm Bill is certain to trigger a global shift in cannabis investing. That's because US-based hemp companies now have full access to the largest, most prestigious exchanges, NASDAQ and the New York Stock Exchange. But will Wall Street create hemp giants that'll leverage their capital and competitive edge overseas? According to Preston Garner, an analyst with CVC Partners, US hemp investors should expect the following: significant merger and acquisition activity, hemp activity in agriculture, pharmaceutical, and technology industries, and American hemp companies seeking a global edge through quality control. The last point could be the best way for U.S. hemp entrepreneurs to compete against larger hemp producers around the globe. Instituting quality considerations such as good manufacturing practices and standard operating procedures will be key for American hemp to find markets overseas. Key takeaways are that millions of consumers use cannabis globally, laying the foundation for a significant market opportunity. Surging investment into cannabis, especially by the CPG entrants of alcohol, tobacco, and pharma, will give market leaders liquidity to acquire assets and capture market share. The most professionally run and efficient operations are going to be prime targets for M&A activity in an increasingly competitive market. Technology will be key to building operational efficiency, including streamlining new product development, lowering production costs, optimizing the supply chain, and more effectively targeting and engaging customers. Cratering wholesale prices are remaking the economics of cannabis, flushing out the least efficient and undifferentiated operators. The growing number of U.S. multi-state operators highlighting the rising expectation of U.S. national legalization in the coming years. The cannabis consumer is not a monolith. They have widely varied reasons for consuming cannabis, creating significant opportunity for segment-specific products and marketing strategies. Product preferences are trending quickly away from flower, even in markets where cannabis is not legal. Medical consumers believe it works, but much more science is needed to understand how and why. And think global, build global, but act local. Aligning business strategies to reflect local political, business, and social cultures will increase brand resonance and effectiveness. And with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge, your cannabis business podcast. Like, subscribe, and share, or don't. And I'm out.